Welcome to the Deep Dive, your shortcut to being well-informed on the latest earnings calls. Today, we're taking a deep dive into the second quarter 2025 results from Millrose Properties, ticker MRP. We've gone through the reports, listened in on the analyst calls, and we've pulled out what we think are the absolute most important insights just for you.
Yeah, and this past quarter was, well, pretty significant for Milrose. It marked their first full quarter operating as a public company. And, the market clearly reacted with some enthusiasm to what they had to say. So we're going to unpack the key financial numbers, dig into their strategic moves a bit, and explore what this all means for their pretty ambitious growth plans, and importantly, the broader U.S. housing market, too.
All right, let's kick things off then. Let's break down the headline numbers for Q2 2025. Millrose Properties reported GAAP earnings per share of 68 cents. Now, that was a slight miss, just by 1 cent against the consensus estimates. However, they also introduced a brand new metric, adjusted funds from operations, or AFFO per share. That came in strong at 0.69 cents. And AFFO, that's essentially a cash flow measure many real estate companies use, right? Gives a clearer picture.
Exactly. It strips out certain non-cash items, giving you a better sense of the actual cash generation from operations. And here's where it gets really interesting, actually. Their revenue from option fees and related income, well, it significantly beat expectations. Came in at $149.0 million. The consensus was looking for something closer to $145.5 million. So a solid beat on the top line.
And that top line beat often carries more weight for these kinds of growth companies, doesn't it?
It certainly can, yeah. Shows underlying business momentum. And annualized return on equity, ROE, also showed some healthy upward movement. Increased by 20 basis points quarter over quarter to 7.8%. Plus, crucially for shareholders, they reaffirmed their commitment by declaring a dividend of 69 cents per share. That signals they intend to distribute basically 100% of those AFFO earnings.
Okay, strong signal there. And the foundation, the balance sheet.
Looks robust. They've got approximately $1.4 billion in liquidity and a pretty conservative debt to capitalization ratio sitting around 15%. So, despite that very minor EPS miss, the market sentiment was overwhelmingly positive, really driven by that strong top line beat and some very compelling strategic updates they shared.
Those numbers definitely paint a picture of a company hitting its stride.
Yeah.
But how exactly is Milrose building this foundation? What's the engine driving it? Let's zoom in on what they call their operational flywheel. Sounds interesting.
Yeah, it is. And what's fascinating here is how effectively they seem to be putting it into action. So they recycled a substantial $839 million of takedown proceeds. That's essentially the cash flow coming in as homebuilders exercise their options to buy the land from Milrose. Net, that was about $797 million after some adjustments.
Okay, nearly $800 million coming back in. What did they do with it?
Almost immediately, they aggressively redeployed $813 million into new non-Lennar acquisitions, so diversifying their client base. And these new agreements were locked in at a pretty attractive weighted average yield, somewhere around 11% to 11.2%.
Wow. Okay, so taking almost all that cash, putting it right back to work at double-digit yields.
Exactly. This isn't just, moving money around. It's designed as a potent self-sustaining engine. Imagine taking nearly $800 million, putting it back to work almost instantly, earning over 11% on it. That kind of rapid capital velocity is what really supercharges their growth. It lets them scale much faster and maybe with greater capital efficiency than a typical land developer might.
Right. Leveraging existing capital to generate more, which then gets deployed again. The flywheel effect.
Precisely. It keeps spinning, generating returns.
That definitely sounds like a highly efficient engine. But, it's a capital-intensive business, and market conditions vary. Are there potential friction points, things that could slow down that flywheel? What are they sort of watching out for specifically to make sure it keeps spinning so fast?
That's a really good question because, even the best engines need fuel and a clear path. Milrose primarily tries to mitigate slowdowns by focusing on partnerships with well-capitalized, established builders, builders with a track record of actually exercising their options. They also used pretty sophisticated underwriting to make sure the underlying demand for the land itself is solid.
And external factors, rates, the economy.
Of course. Things like interest rate hikes hitting home buyer affordability or a significant economic downturn that really dampens home sales. Those are always risks. However, their risk mitigation strategies, which we should definitely get into, are designed specifically to buffer against those scenarios. The aim is to keep that flywheel turning, even through, choppier waters.
Okay, we'll circle back to that risk part. But beyond the numbers and that flywheel, one thing that really stood out was Milrose's clear push to diversify. moving beyond its original big client, Lennar. Can you walk us through some of these new use cases? Some sounded quite intriguing.
Absolutely. And if we connect this to the bigger picture, Milrose is definitely strategically expanding its third-party invested capital. It grew from $1.1 billion at the end of Q2 to roughly $1.3 billion by the time they held the earnings call. They're really positioning themselves as this flexible land capital utility for builders.
A land capital utility. Explain that a bit more.
Yeah, it's about fundamentally shifting how capital flows in the home building ecosystem. They're aiming to be the sort of nimble financial backbone. Milrose handles the capital-intensive land part, which allows builders to focus on, well, construction.
So it frees up the builders' balance sheets, accelerates their projects, maybe.
Exactly. And it fundamentally changes those traditional financing structures. That's especially crucial, in today's higher interest rate environment where traditional bank lending might be tighter.
That is a powerful concept. So what are some concrete examples, these new partnerships that show this shift?
We saw two really major examples this quarter. First, they announced initial closings under a significant new partnership. It was a capital backstop for New Homeco's take private of Lansing Home Corporation. That involved acquiring a $500 million home site portfolio,
right?
Basically providing financial security for a big corporate deal.
Okay, that's one. What was the other?
Even more notably, I think, affiliates of Milrose's manager announced a massive $3 billion land banking capital partnership. This one's with Taylor Morrison, specifically for its build-to-rent brand, Yardly, and it's over the next 2.5 years.
$3 billion, that's huge.
Yeah.
And a major move into build-to-rent.
A critical and significant diversification into rental housing, yeah.
Yeah.
And management highlighted the specific build-to-rent, or BTR, use case is considered de-risked.
De-risked? How so?
Because Milrose finances not just the land, but also the vertical construction, the actual building. So this means they have additional collateral, a deeper stake in the project's success, makes it a more secure investment from their perspective.
I see. So it broadens their market way beyond just traditional houses for sale.
Absolutely. Big strategic move.
Okay, that is a huge strategic pivot, especially into BTR. But let's talk about the market. We all know it's facing affordability issues, those elevated mortgage rates, consumer confidence seems shaky. It sounds like a perfect storm, doesn't it? I mean, Who doesn't know someone feeling the squeeze on mortgage rates right now? How is Milrose navigating this challenging environment while chasing such ambitious growth?
You're right. The market is undoubtedly challenging. We're seeing historically low turnover in some areas because of it. However, Milrose maintains what they call a constructively bullish long-term view.
Constructively bullish?
Meaning they acknowledge the near-term headwinds, but they point to the structural undersupply of housing in the U.S. and, robust underlying demand for home sites. It's a fundamental imbalance that they believe persists long-term.
Okay, so long-term optimism. But how do they manage the short-term bumps?
Their navigation strategy really relies on robust risk management tools. They use a proprietary internal MSA risk rating model, MSA being Metropolitan Statistical Area. This model constantly tracks local supply and demand dynamics, construction costs, all sorts of key indicators, market by market.
So it's granular. It flags specific areas.
Highly granular, yes. For instance, this quarter, it flags some potential softening in certain coastal secondary markets in Florida, places like Fort Myers, Naples, Daytona Beach, and also Austin, Texas.
Okay, so the model flags these spots. What happens then? How do they mitigate exposure when a flag pops up?
Right. Well, crucially, their actual exposure in these specific flag markets is minimal. About 1% of their remaining portfolio takedown proceeds.
Only 1%.
And here's the really brilliant part, I think. All the properties in these flagged areas are fully covered by these geographically diversified cross-termination pooling agreements.
Cross-termination pooling agreements. Sounds complex. What is that exactly?
It's not just like a handshake deal. It's a sophisticated legal and financial mechanism. They pioneered it with Lennar, and now other builders are widely adopting it too. Essentially, it binds builders to their broader commitments, meaning a builder can't easily cherry pick, They can't just keep the best performing properties in the pool and drop the less desirable ones without affecting their entire relationship and potentially other pooled assets.
So it stops them from walking away from just one or two tough spots.
Exactly. It provides a powerful deterrent against arbitrary option terminations. It basically creates a shared risk pool for the builders, makes the whole portfolio much more resilient against purely localized downturns. And get this, approximately 97% of their entire portfolio is pooled like this.
97%. Wow, that is significant protection.
It really is.
Those pooling agreements sound incredibly robust,
Yeah.
a real cornerstone of their risk management. But, let's push that. In an extreme economic downturn, when builders are under immense pressure, is there any scenario where even these protections might be tested? What's the ultimate backstop if things get really, really dire?
That's the critical stress test, right? And it's something they say they constantly evaluate. Look, while these agreements are incredibly strong, you could argue no system is entirely foolproof in a truly unprecedented collapse. However, Milrose's ultimate backstop probably comes from two angles. First, that fundamental long-term undersupply of housing we mentioned. Even in a downturn, demand doesn't just vanish, it often just gets deferred. Good land in growing markets usually remains valuable. Second, their conservative balance sheet and that ample liquidity, the $1.4 billion, that gives them significant financial flexibility to weather storms, even if some options were somehow challenged.
So there's a trade-off, maybe slightly lower yields for this stronger protection.
Potentially, yes. They acknowledge that this commitment to credit enhancements might lead to some modest yield compression over time. Average yields might settle closer to 11% as the portfolio scales, down slightly from that 11.2% on new deals. But they see it as a strategic trade-off. Better risk mitigation for slightly less yield peak. They also point to broader market mitigants too, like generally healthy homebuyer credit quality these days. And things like support from older family members for down payments. There was a Redfin survey noting 21% of Gen Z and millennial buyers use cash gifts, plus somewhat muted home price appreciation recently and ongoing wage growth. All provide a bit of a cushion.
Okay, that makes sense. So with all this strategic activity, the risk management, what guidance are they giving us for future performance? Are they sounding as optimistic as these moves suggest?
Oh, absolutely. They've actually raised their year-end quarterly AFFO per share run rate guidance. The new range is $0.73 per share.
Raised guidance in this environment.
Yeah, it reflects definitely increased confidence in scaling their platform. It's not just a slight bump either. It's a pretty significant signal of management's conviction in their model, especially when, like you said, many peers are facing heightened uncertainty. It suggests they see clear paths to accelerate growth despite those broader market headwinds.
What else? Any other key indicators from guidance?
Yes. Remember that $2 billion stretch target they had for year-end investment balance outside the Lennar program?
Yeah, the diversification target.
Well, that's now their base case, not a stretch anymore.
Wow, that's a huge vote of confidence in executing that diversification strategy.
Definitely. And management also laid out a clear capital allocation strategy. They're prioritizing debt to optimize the balance sheet, and importantly, they stated no plans to issue dilutive equity.
Good news for existing shareholders.
Very much so. Signals focus on preserving value per share. Key catalysts to watch going forward include tracking this raised AFFO run rate, obviously. Also, further third-party deal announcements, particularly in build-to-rent. Bond market funding activities, they actually launched senior notes offerings right after earnings. And potential updates on that prospective REIT election and maybe index changes to broaden their shareholder base. Each of these could be a positive step.
Okay, so bringing it all together for you, our listener, what's the bigger picture here? What does this quarter really tell us about Millrose Properties' position in the market and, where it's headed?
I think Milrose is clearly positioning itself as that flexible land capital utility for builders. It feels like they're fundamentally trying to shift how capital flows in the whole home building ecosystem. And their ability to expand into these diverse use cases like the capital backstop for New Home Co., and especially that huge build-to-rent partnership with Taylor Morrison, it really validates the adaptability and breadth of their platform.
So it makes them more indispensable, broadens their market.
Exactly. It broadens their total addressable market well beyond just traditional for-sale housing, and it potentially makes them a key partner for builders needing flexible capital solutions. The disciplined execution we saw with the operational flywheel, their strategic expansion moves, those robust risk mitigation strategies, especially the pooling agreements, you couple that with a conservative balance sheet and plenty of liquidity, it suggests a pretty strong foundation for continued value creation. And all this is happening against the backdrop of a U.S. housing market that remains, structurally undersupplied. That's a powerful tailwind.
So the market reaction makes sense then.
Yeah, the market's constructively bullish reaction, driven by the revenue beat, the reaffirmed dividend, the raised guidance, it signals, I think, a growing recognition of Millrose's unique value proposition and its potential to kind of disrupt traditional land financing.
We've just dug deep into Milrose's strong quarter, their strategic pivots, the risk management, paints a compelling picture. Now, let's switch gears for a moment. Let's have a little fun. In our This Is Not Financial Advice segment, we're going to pitch an outrageous but plausible trade idea. Think hedge fund analyst pitching the investment committee.
All right, okay. Considering Millrose's Q2 performance and that increasing focus on build to rent, here's an idea we're calling the built to rent to REIT arbitrage play.
Ooh, sounds intriguing. The built to rent to REIT arbitrage play. Lay it out.
Okay, the idea is this. We initiate a long position in MRP Millrose Properties. Simultaneously, we execute a hedged play. We go long an equivalent dollar value in a basket of established, high-quality residential REITs, specifically REITs that focus on single-family rentals, SFRs, or maybe multifamily properties with strong demographic tailwinds.
Okay, long MRP, long basket of established SFR REITs. Walk us through the thesis, the why and the how.
Right. The thesis is basically twofold, and it really hinges on a potential structural transformation for Millrose. First, as Millrose aggressively expands its BTR partnerships, like that huge Taylor Morrison Yardley deal we talked about, they're rapidly accumulating the land component for future single-family rental communities. They're essentially building this pipeline of high-quality, potentially income-generating assets.
Okay, building the BTR pipeline, part one.
Part two. Management explicitly mentioned, and it wasn't just a throwaway line, a prospective REIT election. That feels like a clear strategic intention. Now, once Millrose formally converts to a real estate investment trust, which would significantly expand their shareholder base, attract different types of investors, likely lead to index inclusion, the market will fundamentally re-rate the stock.
Re-rate it how?
It should effectively close the valuation gap between their current land banking model and that of a pure play dividend distributing REIT. The arbitrage opportunity, the potential profit, arises from MRP trading up to the valuation multiples of these established SFR REITs. As it de-risks its BTR portfolio, remember they said financing the vertical construction makes it more de-risked, and as it solidifies its REIT status, think of it like a caterpillar turning into a butterfly. The market tends to value the predictable income stream of the REIT butterfly much higher.
And the basket of other REITs, what's that for?
The long position in the established SFR REIT basket acts as a kind of comp tracker. It shows you where Millrose could trade. And it also acts as a partial hedge against broader housing market volatility. If the whole sector goes down, the hedge helps a bit. Meanwhile, the direct long on MRP captures that significant upside from its structural transformation and the market's reevaluation of its cash flows as they become more recurring and predictable, like a REIT's.
So the ultimate upside is Millrose getting valued like a stable income-producing REIT.
Exactly. The re-rating of Millrose's land bank assets, especially those tied to BPR, into that higher multiple income-producing REIT structure, that could unlock substantial value for shareholders. That's the play.
Okay, interesting idea there. Remember, everyone, that was strictly not financial advice. So let's quickly recap the quarter. Millrose Properties delivered a pretty strong second quarter overall, marked by that revenue beat, an unwavering commitment to its dividend, and a significant raise in its year-end AFFO run rate guidance, all while laying groundwork for these exciting new ventures.
Yeah, their strategic pivot towards more third-party partnerships and these innovative use cases like built-to-rent financing really underscores their adaptability and highlights their long-term growth potential, especially in a U.S. housing market that remains undersupplied. Management's disciplined underwriting, those robust risk mitigation strategies, particularly the extensive cross-termination pooling, they seem to provide a strong foundation for continued value creation.
Ultimately, I think Millrose's journey really suggests that in today's rapidly evolving housing market, the true value might not just be in owning the land itself, but maybe in cleverly orchestrating the capital that brings communities to life. Kind of makes you wonder, doesn't it? What other capital-intensive industries could benefit from a similar utility model? Something to think about. Thank you for tuning into the deep dive. Remember, the information discussed here is purely for informational purposes only. It should absolutely not be considered financial advice. We strongly encourage all our listeners to conduct their own thorough research and, crucially, consult with a qualified financial advisor before making any investment decisions. We always welcome your feedback, and we look forward to having you join us next time for another in-depth look into the world of earnings calls.